94% of millionaires in America live below their means every year. Not sometimes, not during market downturns, always. And here's the part nobody puts in the headline. A prudential financial study of around 20,000 people over 50 found that married 65-year-olds with at least $100,000 in financial assets are only withdrawing 2.1% of their portfolio per year. That's roughly half the 4% safe withdrawal rate that every retirement textbook treats as the floor, not the ceiling. These people have enough to spend more. They are choosing not to. And the 10 categories where they've cut the hardest, those aren't things you'd expect. Several of them are things your bank, your advisor, and an insurance agent with very good shoes are probably actively selling you right now. This isn't a video about being cheap. It's a video about plugging the drains. And by the end of it, you're going to see your own finances differently. Here's what I'm going to show you. Staying wealthy in retirement is a completely different game than accumulating wealth. The accumulation phase is about the faucet, salary, bonuses, investments growing. The preservation phase is about the bathtub. And there are 10 things that act like drains, slow, invisible leaks that look harmless individually but empty the tub over a 20-year retirement in ways most people never see coming. I've spent a long time going through the data, the behavioral research, and the actual numbers. And every single item on this list comes with math that is hard to argue with. Not soft arguments about lifestyle, hard numbers. Think of your retirement savings as a bathtub. When you were working, the faucet was running income, returns, compounding. Now, the faucet is off. What you have is what you have. The only question is how fast it drains. Every fee is a drain. Every bad financial product is a drain. Every identity-based purchase, the thing you bought because of what it signals, not what it does, is a drain. The wealthiest retirees aren't necessarily smarter than average. They're not making dramatically better investment calls. What they've done is identify the drains and plug them one by one. By the end of this video, you're going to see every drain with the number attached. I'll show you the second biggest one first, but stay with me. Because the drain that comes after it, the one the financial industry built an entire business model around keeping invisible, that's the one costing people with portfolios over $1 million, more than $600,000 over the course of their retirement, without them knowing. Let's go. The first thing wealthy retirees stopped buying, a brand new car. There's a man I want you to picture. I'll call him Gerald, 63, retired engineer from Ohio. 6-figure pension, solid portfolio, the kind of guy who maxed his 401k for 30 years straight. Smart man, disciplined man. And every 3 years, without fail, Gerald drove to a dealership and drove home in a new truck. $50,000 truck. He figured it out of pocket change. He figured it was fine. It wasn't fine. And the math will tell you exactly why. According to Kelley Blue Book, the average new vehicle price in late 2025 was hovering around $50,000. The second you sign the paperwork, before you leave the lot, before you turn the first corner, that car is already worth less than you paid. Buyers can expect most vehicles to lose about 20% of their original value in the first year alone. After 2 years, a new car has typically depreciated around 30%. After 5 years, close to 60% of the purchase price is gone. Gerald's $50,000 truck is worth about $20,000 5 years later. He absorbed a $30,000 loss. Not to maintenance, not to fuel, just to time passing and the market repricing the asset he's sitting in. Do that 3 times over 9 years, Gerald's buying pattern, and you're looking at roughly $90,000 in depreciation losses. Money that could have been sitting in an index fund at 7% annual returns. Compounded over 20 years, that number approaches $350,000 from trucks alone. $250,000 from trucks, because Gerald didn't want to drive something with 60,000 miles on it. The wealthy retirees who figured this out stopped. They wait 3 to 4 years, let the first owner absorb that brutal initial hit, and buy the same truck in the same condition for $28,000 instead of $50,000. The truck hauls the same things. The engine has the same miles left on it. It just doesn't cost Gerald half his retirement. Drain, plugged. Now here's a related one. The brand name purchase, when a generic is chemically identical, 93% of American millionaires use coupons when shopping. I want you to sit with that for a second. Not people who use coupons because they have to. People who are genuinely, legitimately wealthy, and they're checking the Costco app before they go to Costco. This is a documented behavioral pattern across the entire demographic. They don't see name brand products as a signal of success. They see them as a drain on a bathtub they've spent decades filling. The FDA requires generic medications to have the same active ingredient, the same dosage, and the same route of administration as their brand name equivalents. Same molecule, different box, different price. And yet the average American pays 30 to 80% more for branded versions of drugs, supplements, cleaning products, and grocery staples that have generic alternatives sitting 2 inches to the left on the shelf. The only thing the brand is selling is the reassurance that you made the right choice. Wealthy retirees stopped buying that reassurance. They buy the ingredient. And then there's the third drain from this first cluster, the subscription you forgot you had. This one is almost funny if you don't look at the compound math. According to a 2026 Deloitte report, the average American household spends $69 per month on video streaming services. The average consumer has 4 paid streaming services at the same time. 4. And that number doesn't include music streaming, cloud storage subscriptions, premium newsletters, apps that auto-renew every year, productivity software with annual fees, and digital newspapers with monthly charges most people haven't opened since the pandemic. The total picture for a typical household is well north of $200 a month in recurring subscription charges, many of which go unused most months. The mechanism here is deliberately engineered. Streaming and subscription companies don't raise prices dramatically all at once. They raise prices by $1 or $2 per service, staggered across the year, timed so that no individual increase ever feels worth the friction of canceling. Subscription pricing is built on inertia. The companies know this. They rely on it. The business model depends on your brain not actively evaluating whether the value is still there every month. The wealthy retirees who plugged this drain did something counterintuitive. They started rotating subscriptions, one at a time. Cancel when you finished what you wanted to watch. Resubscribe when the next thing you want drops. One person who documented this exercise on NerdWallet Canada cut their streaming spend from $89 a month to $20 a month, $830 per year. Not a life-changing number in isolation, but there are 10 of these drains, and they compound. Another drain, plugged. In a few minutes, I'm going to show you the single biggest psychological trap on this list, a product that wealthy retirees almost universally cut, that most people believe is smart financial planning. But first, the drain that the financial services industry specifically designed to stay invisible. Because this next one is different from everything we've covered. This one isn't an accident or a consumer habit. This one was engineered. The fourth drain, and this is the one. High-fee, actively managed mutual funds, and their enabler, the 1% AUM advisor. Picture this. Somewhere in your city, there is a man in a nice office, good suits, diplomas on the wall, a firm name with 2 or 3 last names in it. He manages money for retired people. He charges 1% of assets under management per year. 1%. Sounds almost free, right? Like a rounding error? It is not free. Here's what 1% actually costs. You're 65. You've saved $1.5 million. You hire this man. He charges 1% per year, $15,000 in year 1 alone. But your portfolio grows, a few good years in the market, and now you're sitting on $2 million. Your annual fee just increased to $20,000. You did nothing. The market went up. His invoice grew by $5,000 for the same amount of work. Now do the full 30-year math. According to research from TD Wealth Management, on a $2 million portfolio with a 1% AUM fee, you will pay $600,000 or more in advisory fees over 30 years. And that doesn't account for the compounding you didn't get because that money was gone every year. $600,000. That's a second retirement account. That's a house in most American cities. That's the inheritance you meant to leave your kids. Gone to 1%. And now you're thinking, but the advisor is generating returns that justify it. The market exposure, the risk management, the professional insight, right? The data on this is brutal. According to Morningstar's active passive barometer, just 21% of actively managed funds survived and beat their index counterparts over the 10 years through June of 2025. 21%. That means 79% of the funds people are paying these advisors to put them into underperformed what would have happened if you'd bought a boring index fund and done nothing. Not just a little underperformance. Statistically, systematically, across time, in 2025 alone, a year filled with elections, tariff volatility, geopolitical uncertainty, the exact kind of environment where active managers claim they earn their fees only 33%, beat their passive counterparts after accounting for fees. Brian Armour from Morningstar said it plainly, conventional wisdom says active managers should better manage those complexities. Performance says otherwise. You think the problem is that you picked the wrong fund. But actually the problem is that you're paying for a system that statistically loses over a long enough time horizon. SPIVA, S&P's long-running study on active versus passive management, tracked 20 years of data through 2025 and found that a vast majority of active fund managers underperformed their respective benchmarks. After 15 years, they found no categories, zero, in which the majority of active managers outperformed. Not one category. The market held passively, won. The people who paid for expertise got below market returns. The average expense ratio for actively managed equity funds is 0.64%. For index funds, 0.05%. Actively managed funds cost over 10 times more on average, and they lose. By the way, hit subscribe if you like the content, because otherwise YouTube's algorithm may never surface my videos to you again. Now let me tell you about Robert. Robert is a composite, a story built from patterns I've seen over and over in the data. He worked in manufacturing for 32 years, maxed his 401k every year for 20 of them. He retired at 64 with $900,000. He met his financial advisor at his bank. Nice guy. The advisor set Robert up in 10 different actively managed mutual funds across 3 fund families. Each fund carried a management expense of somewhere between 0.7 and 1.2%, plus the advisor's own 1% AUM fee. Total fee drag on Robert's portfolio, somewhere between 1.7 and 2.2% per year. On a $900,000 portfolio, at 2% annual fees, Robert was paying approximately $18,000 a year in fees. He didn't know. The fees don't show up on a line item in your statement the way a cable bill does. They're extracted from your returns before you see them. Robert saw his account growing more slowly than he expected and thought the market was being sluggish. The market wasn't sluggish. His fees were eating the growth. I'll come back to Robert. His story doesn't end here. Here's the part that never makes it into a standard retirement calculator. Knowing the numbers I just showed you, the fee drag, the active fund underperformance data, that's useful information. But useful information and a working system are different things. I had access to this data for years before I changed anything meaningful about how my money was positioned. The information wasn't the problem. The framework was missing. That's why I built something called the Exit Code. It's a digital book, 8 chapters of pure research, no filler, no opinion, dressed as strategy. Built on 50 years of actual retirement data, condensed into a mathematical framework that turns maybe someday into a specific date with a specific number attached. 2 things it covers that connect directly to what we've been talking about. First, the dynamic withdrawal method, which replaces the 4% rule with a system that actually adapts to what the market is doing year to year, so you're not the person who runs out of money, but also not the person who dies with $3 million they were too afraid to spend. Second, the lazy portfolio, the historically back-tested allocation that has outperformed active traders over 30-year windows without you making a single active decision. That one is the passive argument I've been making, turned into an actual allocation you can implement. Your financial advisor will not hand you this framework. They charge 1% of your assets annually to explain half of it, and then they often recommend products that statistically underperform what they replaced. The Exit Code is available through the link in the description for less than a dinner out. Every year, you delay understanding the actual math compounds against you. Not because I'm telling you to hurry, because that's what arithmetic does. Back to the list. Here's the reversal I've been building toward. You think the biggest spending trap for wealthy retirees is the obvious stuff. Too many vacations, restaurant habits, spending on grandkids. Those are visible. You can see them. The drains that do the most damage are the ones that feel responsible. The purchases that feel like saving or protecting or being smart. The ones your brain categorizes as financial hygiene. That's where the most sophisticated people get caught. Drain number 6, whole life insurance, purchased as a savings vehicle. There's a product the financial services industry has sold for over a century to people who genuinely want to make good decisions with their money. And the pitch is seductive. Why pay for term life insurance and get nothing back? Why not have your life insurance build cash value at the same time? It grows tax deferred. You can borrow against it. When you die, your family gets paid. It's the best of everything. Let me show you what the math actually says. A 30-year level premium term life insurance policy with a $1 million face value, bought by a healthy 30-year-old, costs approximately $680 per year. A comparable whole life policy, same face value, same person, costs between $8,000 and $10,000 per year. That's over 10 times the cost for the same death benefit coverage. Over 10 years, you've paid somewhere between $80,000 and $100,000 for the whole life policy versus $6,800 for term. The difference, $70,000+, could have gone directly into a Roth IRA invested in low-cost index funds. The White Coat Investor analysis shows a Roth IRA compounding over 30 years at market rates growing to approximately $1.1 million. The whole life policy cash value over the same period, about $560,000. You paid more for something worth almost half as much. And the cash value growth rate on a typical whole life policy runs between 2 and 4% annually, a fraction of what the stock market has historically returned over 30-year windows. Here's a number that settles the debate for me. 80 to 90% of whole life insurance policies don't pay out a death benefit. They're surrendered before the policyholder dies, often at a loss, since surrender charges kick in if you cancel within the first several years. Most people who bought whole life eventually figured out they'd made a mistake. They paid thousands of dollars in premiums, got out with less than they put in, and wished they just bought cheap term and invested the difference. The wealthy retirees who sidestepped this didn't avoid whole life because they're frugal. They avoided it because they compared it directly to the alternative. Buy term for the protection you actually need. Invest the premium difference in the market. Over 30 years, the math is not even close. Drain number 7, the vacation home that turned into a second job. There's a concept in behavioral economics called the Diderot effect, named after the 18th century French philosopher Denis Diderot. He once wrote about receiving a gift, a new dressing gown, and within months, he had replaced his desk, his chair, his rug, and most of the furniture in his study, because nothing else in the room looked right next to the new gown. One nice thing created a cascade of additional spending to match it. You buy a lake house. You run the numbers. You factor in rental income during the summer. On a spreadsheet, it almost works out. But the spreadsheet doesn't account for the fact that lake houses aren't much fun without a boat. And the boat needs a dock permit. The dock permit requires an inspection. The inspection finds a small structural issue with the dock. The dock needs work before the summer rental guests arrive. The guest bedroom needs new furniture because your family is visiting in July. The new furniture needs someone to assemble it. You need a local handyman you can trust. The handyman notices a plumbing issue under the guest bathroom sink. Meanwhile, you're managing all of this from 600 miles away in retirement, which was supposed to be the period of your life where you had your time back. Vacation homes as investment assets generally track inflation at best over long holding periods. They are not an investment in any serious financial sense. They are consumption, enjoyment spending, dressed in real estate clothes. The wealthy retirees who avoided this drain didn't avoid it because they couldn't afford a lake house. Many could. They avoided it because they ran the full math, including the Diderot cascade, and recognized the total cost before the commitment. This is where Robert comes back in. 2 years into his retirement, Robert's brother-in-law convinced him to buy a condo in Sarasota. Investment property, rental income. It'll pay for itself. The HOA was $450 per month. The property management company took 22% of the rental income. The condo sat vacant for 11 weeks 1 year when a planned renovation overran into rental season. And Robert spent 4 weekends of his retirement dealing with a broken HVAC unit from 600 miles away in Ohio. The condo wasn't making Robert money. It was consuming his retirement in time, attention, stress, and capital that could have been compounding quietly in a boring index fund. Robert eventually sold it 3 years in, at a slight loss after transaction costs. He says it was the best financial decision he made in retirement. Plugging that drain freed up $290,000 in equity and roughly $12,000 a year in hidden carrying costs that went back into his portfolio. Drain number 8. Speculative investments disguised as once-in-a-generation opportunities. In the 90s, it was penny stocks. In 2008, it was real estate flips. In the early 20s, it was crypto memes, NFTs, and SPACs. In 2025, it's AI-adjacent microcap stocks and option strategies being promoted on social media to people who have never traded an option in their life. The pattern is invariant. A new asset class produces extraordinary returns in a short window. The stories spread faster than the risk disclosures. Regular people who have never speculated before watch their neighbor double their money in 6 months. They move money in, the window closes, most of them lose. And at 65, unlike at 35, a catastrophic loss is not a setback. It's a structural problem you cannot recover from. The wealthy retirees who stayed wealthy avoided this not because opportunity didn't knock. It knocked for everyone. They avoided it because they internalized a simple but counterintuitive rule. If you need your savings to survive, the expected value of a speculative bet is negative. The upside might be real. The downside at the preservation phase of life is asymmetric and permanent. They stopped buying the lottery ticket dressed as a financial innovation. Drain number 9, paying full price when the identical alternative exists for less. This one sounds like I'm telling you to be cheap. I'm not. Let me explain the distinction. Wealthy retirees, not the ones who burn through their money in the first decade of retirement, but the ones who maintain and grow it, have a behavioral pattern around pricing that runs counter to everything you'd expect. 94% of American millionaires consistently live below their means. 93% use coupons. That's not because they need to. It's because at some point, they change their relationship with full price spending. The brand premium paying more for the exact same thing because the label carries a different name became visible to them as what it actually is. A fee for the feeling of having made the premium choice. A drain. This extends far beyond groceries. Wealthy retirees buy durable goods during sales cycles. They time large purchases around year-end discounts. They buy clothing at the end of a season when prices have dropped 40 to 60%. They comparison shop on healthcare procedures. They negotiate on services that most people assume have fixed prices. They are not scraping for money. They are allergic to paying more than market value for anything. The distinction is subtle, but the financial math is not. If you spend $8,000 more per year than necessary across all your category spending, brand premiums, convenience purchases, unreflective, full price buying, and you compound that at 7% over 15 years, you're looking at nearly $200,000 of foregone wealth. Not from extravagance, from the absence of attention. Now, here's the drain that took me the longest to understand, and I think it's the most important one on the list, even though it's the last. Drain number 10, buying complexity. Here's something I absorbed slowly after 10 plus years running a business, surrounded by accountants and fiscal lawyers who move real money for a living. The more complex your financial structure, the more surface area there is for fees, misaligned incentives, and silent extraction to happen. Every product you don't fully understand is a potential leak. Every advisor whose compensation scales with your ongoing complexity has a quiet financial interest in that complexity remaining alive. The wealthiest retirees I've studied consistently have simple structures. A few low-cost index funds, a cash buffer of 12 to 24 months of living expenses, a clear, rule-based withdrawal strategy, a will and a power of attorney, maybe 1 or 2 income properties they understand deeply and have owned for decades. That's it. Not 7 actively managed funds across 3 fund families, not a whole life policy alongside a variable annuity, alongside a leveraged real estate deal, not a portfolio so complicated that only their advisor can explain what's in it. The financial industry sells complexity. The the way a contractor sells renovations. The more you need, the more work there is for them. But a portfolio you can't explain to another person in under 5 minutes is a portfolio where someone is probably extracting value from you at a rate you can't track. The Spiva data keeps coming back to me here. After 15 years, across every category measured, the majority of active managers underperform their benchmarks. The simple thing, a passive index, held, not touched, beat the complex thing over and over. Across market cycles, across geopolitical crises, across periods of inflation and deflation and rate hikes and tariff shocks, the wealthiest retirees figured out something that sounds almost too obvious to say out loud. The enemy of a good plan is a better sounding plan. And there is always a better sounding plan being offered to someone sitting on a significant portfolio. They stopped buying the better sounding plan. They bought the boring one, and they stayed wealthy. Let me show you what all of this looks like in one scenario. David and Sandra, both 62, combined retirement savings of $1.2 million. Their financial advisor charges 1% AUM, that's $12,000 per year in advisory fees alone. They're also in 3 actively managed mutual funds with average expense ratios of 0.8%, adding another $9,600 per year in fund fees. Total annual fee drag on their portfolio, $21,600 per year, just gone. Before they spend $1 on anything, they also both carry whole life insurance policies, premiums of $900 per month each, so $21,600 per year combined, going to policies with cash value growing at roughly 3% annually. They have 4 streaming subscriptions they pay for simultaneously, $83 per month. They buy new cars every 4 years, $50,000 vehicles, depreciating 30% in the first 2 years, meaning they're absorbing approximately $15,000 in depreciation losses every 4-year cycle. And they own a vacation condo in South Carolina with an HOA fee of $500 per month, property management fees of $800 per month during rental periods, and average repair costs around $3,000 per year. Net cash flow from the condo, approximately break even, before accounting for their own time. Now, David and Sandra plug the drains. They switch to a flat fee advisor for comprehensive planning, approximately $8,000 to $10,000 per year in savings compared to their AUM arrangement. They move from 3 actively managed funds to low-cost index funds at 0.05% expense ratios, saving around $9,000 per year in fund fees, while statistically improving their long-term performance. They surrender the whole life policies, take the accumulated cash values, reinvest them, and redirect the $21,600 annual premium into their investment portfolio, where it can grow at market rates. They sell the vacation condo, freeing the equity roughly $285,000 and eliminating $14,400 per year in recurring carrying costs. They start buying used cars instead of new, saving approximately $15,000 every 4-year cycle in depreciation. Total annual savings from plugging the drains, somewhere between $42,000 and $50,000 per year. At 7%, compounded over 20 years, that number, just from the optimization, not from earning another dollar of income, is approximately $2 million of additional wealth. $2 million. From David and Sandra not buying the things wealthy retirees stop buying. That's the bathtub. One final thing before the takeaways, and this is the one Robert would want me to say. Robert, who eventually figured out what his fee drag was costing him after his 2nd year in retirement, made the switch. Flat fee fiduciary advisor, low cost index funds, a boring rule-based withdrawal strategy. He didn't feel anything change. No dramatic moment, no sudden revelation. His account statements just started reflecting more of what the market was actually doing because there were fewer people reaching into the bathtub. Robert said something I think about a lot. He said, "I spent 30 years trying to earn more and about 3 months figuring out how to stop losing what I already had." That's the shift. That's what wealthy retirees figured out. Here are your 3 specific takeaways, calibrated exactly to this topic. First, calculate your total fee drag this week. Not, my advisor charges 1%, your total advisor AUM fee plus every fund expense ratio in your portfolio. If that number is above 0.7% of total assets, you are almost certainly paying more than the statistical value being delivered. Move the SPIVA report and ask yourself honestly, do I have reason to believe I'm in the 21% that beats the index? If not, you have a decision to make. Second, run the Diderot audit on any major purchase you're considering in the next 12 months. Whatever it is, second home, boat, new vehicle, major renovation. Write down every secondary purchase that asset will require. Boat needs a trailer, trailer needs a hitch, lake house needs a boat. Include the time cost. Now, price the same capital invested at 7% for 10 years. Compare those two numbers. That's your real decision. Third, build the boring portfolio and set a rule that you don't touch it. Total US market index fund, international index fund in an appropriate ratio, short duration bond allocation calibrated to your age and risk tolerance, cash buffer of 12 to 24 months of living expenses, automate withdrawals, ignore the noise. Over any 15-year window in the SPIVA dataset, this approach beat the majority of active management in every category measured. That's not a theory, that's the data. Lazy investing built more fortune than crypto memes. And the people who figured that out are driving used pickup trucks, watching their money compound quietly while everyone else is at the dealership, being told that a vehicle losing 60% of its value in 5 years is an investment in the